Practical accounting, the better way to learn. Welcome to inventory.
Hey, welcome to inventory. We're here. You know what's cool about inventory? Everybody can relate to inventory. When you go into the store, when you go anywhere to buy something, when you walk in the door, what's on the shelf? Inventory.
That's why it's there. It's because they bought it with the intent to sell.
That's what we're going to be talking about in this particular module. So there's a lot of meat on this bone, believe it, because there's a lot of stuff on the shelf that we want to uncover. We're going to go behind the scenes and see how inventory is impacted, what they do with it, how we're going to use it. And Professor Hill is going to tell you all about it. What else is in this module?
Oh, I don't know. Let's just take a brief look inside.
Sounds good.
Okay. What we're going to do is we're going to start out with the 10 basic transactions. And look at this. We're really focusing on the use transaction. We're using inventory. Inventory is going to go down in so many different ways. And we're going to increase cost of goods sold. This is the primary focus of this one chapter, is use inventory to sell into cost of goods sold. Then we're going to give you the key issues and terminology. Then we're going to get into the different assumptions and methods. I'll be doing that in the next module. We're going to review the operating cycle for one last time and close it out, and focusing on the things that are relevant to inventory costs, including financing, storage, theft, damage, and obsolescence. We're going to drill down and tell you why we love inventory and why we hate inventory by working through a simple example. In our second major module, we're going to give you a comparison of a perpetual inventory system. And what's that sound like, John?
Beep.
And
beep.
Periodic inventory system, which are really cheap. Okay, and then we're going to go on and show you how the transactions look differently for these two types of systems using our unique base method, which is a lot easier to understand. Then we're going to go in and do an example. This is all filled in now, but when you see it on screen, I'll be filling it in for you. We're going to do a count of seven different methods. 1, 2, 3, 4, 5, 6, 7 different methods. This is everything they can throw at you in this chapter. We're going to do it with simple numbers, simple examples, and we're going to drive it through the income statement, and you'll be good to go. We're going to reinforce the average cost calculation, and then give you a chance to practice yourself with a similar problem with different numbers, and then we're going to have the solution right behind that. In our then we're going to start talking about inventory layers, which is an additional level of complexity. We're going to try to make it as simple as possible. Usually they throw layers at you simultaneously, but we're breaking it up so you can grasp it in meaningful and digestible chunks. We're going to do FIFO, LIFO, periodic, perpetual. We're going to show you that thing too, which we'll get into. Then we're going to get into the final management issues, a trade-off of how much to stock, some critical knowledge about internal controls, how to reduce the risks and excess costs of inventory. We're going to come up with 2 major issues, how FIFO and LIFO have different impacts on the financial statements on the top part of this action-packed page. And then what happens if your physical inventory count has a boo-boo and an error. We're going to do both of those on one page and make it real clear with simple numbers. And then finally, we're going to have some other financial statement impacts and some good news about ratios and how they are similar to what you learned in the last module. So
told you there's a lot of meat on this bone. You better get rested because we're going to talk inventory. Stay with us.
Okay. See you inside. All this content
and more
at practicalaccounting.com. See you there.